All right. So my plan for tonight, we're going to review each class. We'll go class by class. I'll just give you a quick discussion of each class, and then we'll go to the quiz. In terms of the logistics, let me know if you think this is going to work. I want to go through the classes like this. I've got slides from previous classes if you need any. We can just take them all. Yeah. I might do. They're all going in the recycle backpack. So what I want to do, so we don't have to bring the screen up and down, I want to go through the slides like this. Say, hey, boom, boom, and it's going to be a little hard to see, but I think we can make it work. Boom, boom, this kind of thing, and then we can click to the quizzes like this, and then scroll like this. And then when we're ready to work stuff out on the whiteboard, I can do one of these. I'm going to work it out. Is that going to work? Do you think? Sound good?
Yeah.
All right, excellent. So, starting with class 1, we just learned basic time value of money concepts. If I have money now, how much is it going to be worth 20 years in the future? Y'all remember the future value formula? All right, if I'm going to give you money in 10 years, what's that worth today? You may have to also calculate the interest rate. If you have $1,000 now, you're going to have $6,000 in 8 years. What's the interest rate you're earning? You may have to calculate time periods. Remember we did the logarithm thing? So how long will it take for $1,000 to become $1,500 at 6% interest? And you have to solve for the little exponent using the log thing. I think that's pretty... Oh, and there's the... let's go over periodic rates, nominal rate, and effective rate really quickly. We, ever since class 1, have been assuming that they're all the same, but in class 1 we discussed the nuances just in case you see something on a bank contract that confuses you. So periodic rate. What is the periodic rate? It is the rate per period. And like I said, we have just used periods of 1 year at every class since then. And we've assumed that that periodic rate, if we say it's 8%, hey, 8%. Periodic rate is 8% over 1 year, and that's the same as the effective rate because it's a period of 1 year, and it's already in that. And it's the same as the nominal rate because we said it's 8%. But sometimes bankers might tell you a nominal rate of 8%, but then they will also tell you the periods that compounding occurs in. So they might tell you a nominal rate of 8% compounded quarterly. So, what is the periodic rate of 8% compounded quarterly? First of all, what are the periods? Yeah, there's 4 periods, and the periods are quarters. And the periodic rate is what? If it's 8% compounded quarterly. Periodic rate is...
32?
No. It'd be nice.
Divided by 4, right?
2.
2. 2 is correct. The periodic rate is 2%. And then what's the effective rate going to be? The effective rate is, if we were to give you that in a period of 1 year, what would the comparable rate be? It's not going to be 8%. It's going to be a little different than 8% because the 8% is compounded quarterly. So if we were to look at it at an annual comparable effective rate, what would it be? First of all, would it be more than 8% or less than 8%? Carlos says more? All right. And can you explain why?
Because it's confounding, so it's 8% the first quarter, then 8% off, close at previous 8%.
Yeah, it's 8% on a quarterly basis, which is 2%, as Charminsta pointed out. So it's 2%, 2%, 2%, 2%. That all compounded together is going to give us like 8.16%. Okay? So that's nominal rate, effective rate, periodic rate. And the only other thing you need to know is future value, present value, solve for interest rates, solve for time periods. There will not be any annuity questions on the exam. Okay, so I think that's all you need to know for chapter 1. Let's look at the quiz, and we can probably go through this pretty quickly, but if we're going through it too fast, just let me know and we'll stop, explore some of these questions more. First question, quiz 1, which of the following is correct? This is just some stuff about timelines, which I think everyone probably got right. This is similar to the question I just asked. Your bank pays a 8% nominal rate of interest. The interest is compounded quarterly. Which of the following statements is correct? The periodic rate of interest is 8%. So the one that is correct is that the periodic rate of interest is 2% and the effective interest rate is greater than 8%. Because 2%, like Sherman said, told us, we're compounding quarters. Carlos said that the compounding effects gives us more than 8% if we were to compare it on an annual basis. You may have to figure out which one has the highest effective annual return based on nominal, periodic, effective rate. Man, does anyone want to stop at this one? Just a nuance of what we just talked about. Okay, Ellen now has $125. How much will she have after 8 years if she leaves it invested at 8.5 with annual compounding? So, can someone give us a quick thumbnail on how we're going to solve this problem? Tell us the formula we might use. Future value. So present value equals, what's the formula for future value? Yeah, so yeah, everyone good on that? Look right in the slides. Slide 1. You would solve it that way. And again, like I said, if you want me to actually stop and work this out on the board, say, stop, work this out on the board. Suppose state of North Carolina bond will pay $1,000 10 years from now. If the going interest rate is a 10-year bond is 5.5, how much is the bond worth today? Someone want to give us a sentence on how we're going to solve this problem? Don? Yes, we're given the future value. We use that same formula to calculate the present value. Good. All right. What is the present value of a perpetuity that pays $250 per year if the annual interest rate is 5%? Can anyone remind us what the perpetuity value of a perpetuity formula is? Yep, so 250 divided by the interest rate, and what's the interest rate? 0.05. That's going to give us the value. And that's going to come out to $5,000.
We allow them to use our formulas, right?
Yeah, it's all open book, open note, and you need some sort of calculator that's not a cell phone or doesn't have a connection to the internet.
So we can read the slide, right?
Yep, open book, open note. Yeah.
Future value, present value.
Sure.
Okay, so
What is a future value table? Sounds.
the table is all that.
What?
Exactly.
I've never seen it.
There's years and interest
Is it gonna have the exact answer? I mean, I guess I'd be
No,
impressed if it did.
With the table, I don't need to calculate it.
Oh.
what is it called? Timetable.
Timetable.
Yeah.
Yeah. I guess that's fine. Right, but I'm interested. Show me that.
You probably know that.
Yeah, but I mean, there's so many different things. Like every possible question gives you a table. I guess I'd be more impressed that you're able to figure out a table like that than actually use the fairly simple formula. All right. How much would $1 growing at 3.5% be worth in 75 years? All right. How are we going to solve this one? Carlos?
Future value.
Future value. Given the present value, we need the future value. Plug everything in, 75 years. Easy, like Sunday morning. Your investment account pays 8% compounded annually. If you invest $5,000 today, how many years will it take your investment to grow to $9,140.20? How are we going to solve this problem? Danelle? Okay, fair enough.
The log.
Yes, we are. We're going to use the log thing, but we're going to use the future value formula. We're just going to plug in everything we know on the present value future value formula, and we're going to have the exponent that we need to solve for. Should we do this one? I'm actually a little rusty on this one. Oh. So you all are going to have to talk me through this. Hopefully someone has their slides open. All right. All right. So $1 growing at 3.5% be worth. Wait, is that we're doing that? It's the next one, right? 8%. Okay, 5,000 to 9,100. We're on that one, right? All right. So let's look at our formula. Is future value equals present value times 1 plus I raised to the n. Every question we've talked about so far can be plugged into that formula. So what do we know about our future value? We know that it's $9,140.20. 9140.2 equals present value, we're told, is $5,000. Interest rate, we're told, is 8%, 0.8, and we do not know the n. So how do we, all right, what's our first step here? We need to solve for the n, and we're good.
Divided by 5,000.
Yep, so let's get this part of the equation by itself. So let's divide both sides by 5,000. Divide that by 5,000. Divide this by 5,000. And that's going to leave us, what's the answer to this? $1.828. Okay, 1.828. All right, so that's looking better. We need to do something to get this n out of the exponent. And what's our trick there? I think it starts with natural, ends with og. Take our natural log of both sides. So if we take the natural log of both sides, including this, then what that allows us to do based on some property we might have learned in high school, which I vaguely remember, it allows us to say that we can take the n down from the exponent and deal with it that way. So, is this right? Does anyone have their slides open to this part? Correct me on this if I'm wrong. So that allows us to what? Yeah, what can we do? Somebody tell me. I'm on this side of the equation right now.
N L
1.08. 1.08. So the natural log of 1.828 equals the natural log of 0.08, right? Times n. All we need to do now is get n by itself. So we divide by the natural log. I put ln, sorry. Yeah, natural log. That's right. Natural log. Log natural. 1.8. Alright, and that's going to mean that n is going to equal this divided by this. So we're going to divide both sides by n. 1.8 equals so n 1.828 divided by ln 1.8. And what does that equal? I want to do a quick rehearsal on your calculator just so you remember how to hit those LNs.
I think I missed something. When did the 1.08 become a 1.8?
It's
Yeah.
1.08.
08?
1.0.
My bad. Thank you.
Thought I missed the stretch property.
Thank you, Carlos. Seven point 7.834. All right. Is anyone who is rehearsing with their calculator, did you come up with that answer?
Yep.
Okay. If you're still in the middle of that calculation, I'll give you a minute just so you feel like you can do that natural log thing under pressure.
Benicia, did you need any of the past slides? Yes. Okay. Excellent.
All right, we're good on this? Anyone want me to stop? Okay. All right. Very good. The answer is 7.84. Next question. You have just purchased a U.S. Treasury bond for $747.25. No payments will be paid until the bond matures 5 years from now, at which time it will be redeemed for $1,000. What interest rate will you earn on this bond? Let me go ahead and I'll put this in the present value, future value formula, and then we'll see if we want to work it out from there. So we know future value equals present value times 1 plus I raised to the n. So what is the future value in this situation? 1,000. Excellent. And what is the present value?
747.
747.25. All right. And what is the I? We don't know. Yes. We don't know I. And what is the N?
5 years.
5. Okay. And so we just crank that out. And the only real tricky thing is we need to take the fifth root of whatever we get when we clean this up. Let's just do that. We'll do that real quick. All right, so what's the first step here?
divided by 747.
Yep, let's get this 747 out of the way. Divide by 747, 25. So what do we get when we take 1,000, we divide by 747, 25. $1.34. All right, what's the next step here? And we do not divide by 5. Yeah, we take a root, the root, a root, the fifth root. So we take the fifth root of both sides. So we have an inequality we're going to solve, so we take the fifth root of this, and that's just going to cancel the 5. Our real interesting, or the real thing that interests us is the fifth root of 1.34. I'm going to do a test run in your calculator, make sure you're fluent on that. Fifth root of 1.34.
It's 1.06.
1.06. Sounds okay to me. Does that meet with everyone's approval? Okay, so 1.06 equals 1 plus I, so we know that I equals 0.06. Yep, this is the answer. Anyone want more time on that? Further questions on that? Excellent. Alrighty. After receiving a reward for information leading to the arrest of a notorious criminal, you're considering, so this is an annuity, we don't need to talk about it unless anyone wants to. Annuities are not on the exam. We had our fun with them. Remember from them for the future. Alrighty. So, moving right along to class 2. Okay. Alright, now the main thing we talked about in class 2 was cash flow. We did a calculation for free cash flow. We thought about how to get that. I took you through an income, let me move this down. I took you through an income statement example just to give you the understanding that, cash and income, actual cash and income on the income statement are different things. And we ultimately came up with this term to calculate our free cash flow was NOPAT, net operating profit after taxes. We started with EBIT, which is earnings before interest and taxes. Does anyone remember why we do not want to use EBIT as our free cash flow number? It has, I'll give you a hint. It is before taxes, but we want, yes, it is before taxes. That's one thing we don't like about it. But why can't we interest earnings before interest and taxes? What did I say? Yeah. So it's before taxes, so we want to make that up. What question am I trying to ask? So EBIT, interest, earnings before interest and taxes. All right, so what we like about that is it's before interest and before taxes. Well, the question I meant to ask is why don't we like net income? Sorry, I'm confused there. See, Frida, it's like pressure is on. Anyone forgets. So why do we not want to use net income? It does take out taxes, which we like, but it does something else which we don't like. It takes out interest. And we want to consider this before interest is calculated, because we need a free cash flow to both the debt holders and the equity holders. Net income is already considered half of that equation for us. In a way, this is going to be confusing. So we want to start with EBIT, and then we take out taxes, and we get what's called NOPAT, net operating profit after taxes. That is going to be our free cash flow figure. It's going to be most of our free cash flow figure. One other thing we want to do to that NOPAT figure is we want to take out investments we need to make in our operations of our company to keep this free cash flow going indefinitely. Investments in factories, investments in whatever we need to continue this free cash flow into the foreseeable future. And the way we got to that, so our free cash flow is going to be our net operating profit after taxes minus our investment in operating capital. And in order to get to operating capital, we said, what was our investment in operating capital? We say, well, what was our operating capital last year compared to this year? What was the change? So if we had $1,000 of operating capital last year, and we have $1,500 of operating capital this year, what was our net investment in operating capital? Yeah, we had 1,000 last year, we had 1,500 this year. What's our net investment? $2,500. No. I see where you're coming from, though. So, operating capital. It's stuff in our on our books in terms of current assets. It's also maybe our factories, our machinery. We had 1,000 of it last year, and now we have more this year. After you, being the smart business students, examine the financial statements, we say, look at this company. It used to have 1,000 in operating capital. Now it has 1,500 in operating capital. So they invested in operating capital. They spent money that we don't get as the owners because they needed to spend that money to keep operations going. So how much did they invest in operating capital over the course of a year? 500. Right? So they had 1,000. Now they have 1,500. So they invested 500 in order to keep operations. That's what it took to maintain that cash flow. Make sense? So we'll go through a process where you recalculate what was operating capital last year, and in that we're going to include working cap, this calculation of current assets minus current liabilities, which gives us our working capital. And we're going to see what on top of that do we have in terms of operating long-term assets. But the main concept is we had 1,000 last year, we have 1,500 this year. Oh, they invested $500 that we don't get as the owners because that's what they need to keep operations going. There's a couple little nuances in terms of calculating the operating capital last year, operating capital this year. So we remember when we're calculating our current assets, we include cash and inventory and receivables. But when we look on the balance sheet, we do not include short-term investments because that's not something that's a part of operations. Any money they put into that account, we don't need to consider that money that is sustaining operations. It's just something the CEO decided, let me invest in that because it's different or whatever, or it's safe for the time being. On the liability side, when we're calculating this change, we're going to look at things like accounts payable and accruals. One thing we're not going to consider on the current liabilities is accounts payable. Okay, so let me sum that up. I see some scared faces. I feel bad. It's been a month and a half since we went over this, and that's understandable. But the main idea is we want to calculate free cash flow. And we're going to start by finding NOPAT, which is EBIT after taxes. Then we've got our NOPAT. The adjustment we want to do to NOPAT is how much did we invest in operating capital. I just gave you the silly example. You had 1,000 last year. You have 1,500 this year. So that means you invested 500. So let's subtract 500 off of NOPAT. And we get into our free cash flow number. And then I added a couple other reminders, pieces of information. When you're going through that process of calculating how much operating capital you had last year or this year, you follow the procedure that you have in your slides, but just remember, do not get tripped up, and remember to exclude short-term investments on the current asset side and exclude notes payable on the current liability side. So big picture, NOPAT, take out how much you invested in operating capital, and in the nitty-gritty of actually doing that, don't get tripped up on those things and make sure you're excluding those two items. Any questions? All right. So let us. Wait a minute, what happened? Oh, that close. Do the slides. Okay. All right. So, first one. True, false. Actually, let me do this. Let's let you and you all answer these questions. Again. All right, here we go. True, false. Net operating profit after taxes is the amount of net income that a company would generate from its operations if it had no interest income or interest expense. Is that true or false? Net operating profit is the amount of net income we generate from its operations if it had no interest income or interest expense. Who says false? All right, the correct answer is true, because the reason we calculate NOPAT, the problem we have with net income is that it takes account of interest income and interest expense. And we do not want to account for interest income or interest expense. We want a number that is pre-interest payments. So we can look at the big picture of what's available for the debt holders and what's available for the equity holders. If we've already taken out what the debt holders have coming to them, then it's a corrupted figure, and we want a pure figure. So this is true. NOPAT would be net income if we didn't have any interest income or interest expense. Net operating working capital, also known as working capital, is equal to operating current assets minus operating current liabilities. True? True is correct. Current assets minus current liabilities. And remember, there are a couple things you're going to exclude from your calculation of current assets. One from current assets and one from current liabilities. What's the thing you're going to exclude from current assets?
Short-term investments.
Yes. What's the thing you're going to exclude from current liabilities?
Notes payable.
Notes payable. Yes. Yes, that's all you got. You got it? I was worried there for a minute. You all got it. Which of the following items is not included in current assets? Number 3 here. All right, if you know the answer, just yell it out. Bonds, yes. Everything else is included in current assets. Accounts receivable, short-term, highly liquid market receivable, inventory, cash. Bonds is not. Number 4, interest paid by a corporation is a tax deduction for the paying corporation, but dividends are not taxable. This treatment, other things held constant, tends to encourage the use of debt financing by corporations.
True.
True. I like true. Any questions? Debt is lower. All right, number 5. NNR's balance sheet showed total current assets of that much plus fixed assets. All these assets were required in operations. All right, when you hear that, all these assets are required in operations. They must be talking about some sort of operating capital. And if we have to increase that, that's money that was required to keep operations going. The firm's current liabilities consist of 4,500 accounts payable, 375,000 short-term notes payable to the bank, 15 of accrued wages and taxes. The remaining capital is considered long-term debt and common equity. What is their investor-provided operating capital? All right. So, someone talk me through this. How are we going to find the operating capital figure?
Could you scroll down a little bit so we can see the words? Could you scroll down a little bit so we can see the words?
Gosh, can't read off metal. Okay, so to start out, we're going to find our working capital, which is current assets minus current liabilities. And we have this figure here for current assets. It looks like a good figure. There's nothing we need to take out of that because they haven't told us anything. They haven't broken it down for us. So that is our current assets. So we're going to take 1.875 million minus current liabilities. And we know that current liabilities is 475,000. Consists of 40, wait a minute. Okay. Okay, we know that current liabilities includes 475,000 notes payable, 375,000 short-term bank, 150,000 accrued wages. Okay, so we're going to subtract those from current assets, but there's one we're not going to include. Notes payable. Right, so we're going to take 1.875 million, we're going to subtract off 475,000. We're not going to subtract off these the 375,000 because that's financing. We are going to subtract off the 150,000, and then that's going to give us our working capital. And once we get that, we're going to add this 4.225 million to it. You with me? All right, everybody do that really quick because this was kind of scary going through that. So let's take the 1.875 million, subtract off 475,000. Do not subtract off 375,000. Forget about it. Subtract off the 150,000. And once you do that, add the 4.225 million. 5,475,000 is correct. Everybody get that? Alrighty. Any questions on that? No? Alright, question 6. TSA has the following data: net income, NOPAT, total assets, total operating capital, information just completed, net income. Oh, we've got we've got last year, and then we've got this year, and we want to figure out free cash flow. Alright, now remember, free cash flow is EBIT minus EBIT with taxes taken out. It's going to give us NOPAT. Minus our investments in operating capital. And we just have to work through this. Does anyone want to work through this? It's just crunch through it. No? Move on? Yes? Yes? Okay. Alright. We've got some yeses. So, net income, $800. Net. Alright. Farm income. So, income 800. Okay. So, TSW had the following income. So we were going to look at the current year. We're going to look at the NOPAT. You can see we have a NOPAT of $700 this year. So we don't even have to figure out the EBIT taking out taxes. We know that NOPAT for the current year is $700. And what do we have? What's the one other thing we need to do? I'll give you a hint. Subtract off
Investments.
in operating stuff. Investments in operating stuff. So, let's take a look at what are our investments. We have total assets, total operating, and the following data for last year: net income, net operating capital, total assets. All right, we have total operating capital is given. All right, so total operating capital, yeah, so that's good. So we don't even have to do that current assets minus current liabilities. We have the total operating capital of last year of 2,000. And we have a total operating capital this year of 2,500. Okay. So last year we had total operating capital of 2,000. This year we have total operating capital of 2,500. What is our investment in operating capital? 500. All right. So we subtract how much free cash flow did we do just completed year. Okay. So, all right, I read this wrong. The NOPAT for the current year is 925. Last year was 700. NOPAT for the current year is 925. 25, so we subtract 500 from 925, gives us 425. And that is the answer. Let me pull that up on the screen so you can think about how we were able to pick through all this scary looking verbiage and pick out the two important things, the 925 and the 500. All right. So it gives us following data for last year, and then it gives us the data for this recently completed year. All right, in the recently completed year, it tells us NOPAT is 925. What if it told us EBIT instead of NOPAT?
We need the tax rate.
Then we would just take out taxes and we would get EBIT and we would get NOPAT. But this actually gives us NOPAT. So we know 925 is our NOPAT for this current year. That's going to be the first step in the free cash flow. But we're going to subtract off, as Carlos told us, investments in operating capital. And as we scan this information, we see, all right, last year they had operating capital of $2,000, and this year they have operating capital of $2,500. So how much did they invest in operating capital? 925 minus 500 gives us the answer. All right. Question 6. Bay has the following income statement. How much net operating profit after taxes? So NOPAT is what we need. We know NOPAT can be calculated by finding EBIT, taking out the taxes. So what do we got? EBIT, 700. Yeah. Taxes, 35%. I want to fire that off on their calculator real quick. So 1 minus 0.35. We get to keep 65% of this EBIT. So 65% of 700.
455.
455 is the correct answer. Rocking and rolling. Tibbs Inc. had the following data. It's going to say, what is the investor provided return on capital? So, we learned also that once we calculate the operating capital, we can do more than our free cash flow valuation. There are a couple other things we learned. One is the return on economic capital, and the other is the economic value added. And what is the formula we want for return on invested capital? Sounds right to me. Is that right? Yeah. So NOPAT divided by operating capital. So we need to scan this information for two things. After you flip your slides and say, oh, what was the formula for return on invested capital? NOPAT over operating capital. So let's see if we can find NOPAT. All right, so we've got NOPAT of 400. It's just talking about 1 year. It's not 2 years. And it actually gives us total operating capital of 2,300. Is it that easy, or did I miss something? Okay, so 400 divided by 2,300 should give us one of these. Should be the right answer.
17.39.
I like it. All right. Barnes Brothers has the following data, blah, blah, blah. This is asking for economic value added. So you flip to your slides. Gosh, what was that formula for economic value added? And what is it?
Total net operating capital times ROE minus what?
Times what?
Times ROE, or return on capital minus what?
It's return on capital. Okay. Return on invested capital.
So it's total net operating capital times return on invested capital minus what?
Okay, I feel like you're missing something. WACC, do we need to multiply WACC by something? Economic value added. All right, NOPAT minus WACC times operating capital. Okay, so we need to take our weighted average cost of capital times our operating capital, and that is how much our investors are demanding. Now the question is, what was NOPAT? So WACC should be given, and the other two, hopefully they're given. Maybe they need to be calculated. So, let's see. NOPAT, boom, 700. I like it. We've got one of the three things we need there. And I know they're going to give us WACC because we hadn't learned to calculate WACC at this point. So weighted average cost of capital is 10%. All we need now is our operating capital. So do we have to calculate it, or No, look at this. Total operating capital. This is a joke, man. I should have made this hard. Just kidding. So you plug that into the formula, you get one of these, which is the right answer. Sound good? All right. HHH reported blah blah blah. This is an economic value added. It's the same thing. Do we need to go through this one? No? Alrighty. Fantastic. Oh wait, no. Stay on this page. So let's go here. X out of this. Let's go to class 3. Okay, I think we can go through class 3 pretty quickly. These are just these financial ratios, right? Yeah. So these are tools you might use when you're up at 2, 3 in the morning in your cubicle at Morgan Stanley or Bank of America. And the next morning you need to tell your boss, this is a strong company, this is a weak company, these are some things we should be aware of. You will determine a lot of that information with your ratio analysis. If you get asked a question like this on the exam, you'll just scroll through, say, oh, what was the current ratio? What was the quick ratio? And you'll calculate it. You may compare it to the industry average. You may say, ooh, that's lower than the industry average. That's bad. Or you need to know if this is a ratio where higher than the industry average is bad. You need to know how to calculate the ratio and whether above or below is good or bad. So you should just have these at your fingertips. You know, days sales outstanding. Well, let's go calculate that. All right. Any questions on that? We'll fire through the quiz quickly, but it'll be the same process of. I want to leave this page. I'm not taking the quiz. Alright, let's take a look at this first one. Ratio analysis involves analyzing financial statements in order to appraise a firm's financial position and strength. Well, that's obviously false, right? I'm just kidding. Yeah, of course, that's what ratio analysis is. Alright, considered alone, which of the following would increase a company's current ratio? If you know the answer, just yell it out. If you don't know the answer, don't worry too much about it. You can figure it out if you think about it. Sorry, what? That is correct. That is the correct answer. So you would just, if you had a question about that, you flip open your notes. What is current ratio? Well, there's current assets over current liabilities. What is included in current assets? Accounts receivable. So if that goes up in the top line, that's going to increase the current ratio. Right. Company Heady and Laudy are virtually identical in that they are both profitable and they have the same total asset, sales, return on assets, ROA, profit margin. However, Heady has a higher debt ratio. Which of the following statements is correct? Alright, if you know the answer, just yell it out, but let's not get bogged down on this. So, I'm sorry. Okay, can I told you, please turn your cell phones off? That's my undergrad calling me for money. Alright. If no one knows the answer is the third one, but let's not worry about this. This is going to distract us. And if you have to think about it on the exam, you'll just think about it. Number 4, I feel like is the same thing. It's just something that's going to hurt our mind unnecessarily. Number 5 is asking us what's the total asset turnover ratio. So if you get a question like this on the exam, you're going to look, what's total asset turnover ratio? You're going to plug in the numbers they give you, and you're going to get the right answer. Hutchinson Corporation, what is the... Alright, so how much must the firm borrow to achieve the target debt ratio? So this one is a little bit more complicated in that you need to determine what the debt ratio is now, and then you'll need to plug and chug to figure out what they need to get their target debt ratio. It's just a matter of setting up the algebra. You may have to do it, but anyone want to do this one? Yeah? Alright, fair enough. Let's do it. Alright, so I think I can do it over here. So, So, Hutchinson Corporation has 0 debt and is financed only with common equity. Total assets are $410,000. New CFO wants to employ enough debt to bring total asset to debt ratio to 40%, using the proceeds from borrowing to buy back common stock at a book value. How much must the firm borrow to achieve the target debt ratio? So what is debt ratio? I know we threw this term around loosely a lot, but according to your class 3 slides, what is the actual this over this that we need to solve? Yes. Total debt over total assets. That's going to be our debt ratio, at least as far as this problem is concerned. Ratio. So, alright, we know it has 0 debt. We know total assets are $410,000. So we need to solve for this new amount of total debt, which we'll call X. And we know that the total assets are 410. How much must the firm borrow to achieve the target debt ratio? So we know we want this to equal 40%. Let me think for a minute. Is it how much debt? So he wants to employ enough debt to bring total asset to ratio. Okay, so and this is going to be, what is it? It's going to be 410,000 plus X. Is that right? Okay. Is that right?
I can't see that.
You can't see that, sir? Alright. Alright, so currently they have 410,000 in equity. We want to know how much the CFO can borrow to bring, so once he borrows, that's going to increase this. I think that's right.
Yeah.
Right? I'm setting that up right? Alright, so how do we solve that? Let's, what do we do? We would multiply both sides by 410,000 plus X. And then we would get X equals 40% times 410,000 plus X. So, we take 40% of 410,000 is what? Like 164,000. Excellent. Plus 0.4 X. X equals, so now as we subtract off 0.4 X from both sides, minus 0.4 X, that's going to be 0.6 X equals 164,000. So what's the last step we're going to do?
Divided by 0.6.
Yep, we divide by 0.6. So 164,000 divided by 0.6. Hit me with it. did something wrong because the answer is 164,000. What did we do wrong?
The plus
Like
X.
14 by 40,000. and then
40%.
I got the answer.
410.
This is 40%?
Yeah.
Alright. Finance with common equity. Its total assets are 410,000. The new CFO wants to deploy enough debt to bring its debt to asset ratio to 40%.
The total asset is 410.
We're gonna need to add
So you don't need to add the X with the
Yeah.
total X.
Okay. Alright. Sorry about that. So, it's just a question of. It's just a question of. X over what? X over 410,000 is 40%. And this gives us 164?
Right.
Yeah.
Or X equals 164,000. Okay. Sorry about that. Any further questions on this? Right. So, Rappaport Corporation's last year's sales were 320,000. And its net income was 23,000. What was profit margin on sales? Flip through the slides, see profit margin on sales. I think it's very likely it's going to consist of those two numbers, and you're just going to divide. Same thing for this last one. What is the return on total assets? Look through your slides, figure it out. Number 9, what is ROE? Return on equity. So we're given net income, we're giving equity. Divide one by the other. Question 10. Northwest Lumber had a profit margin of this much. What is ROE? This one is a little more complicated to figure out. Just takes some cutting and pasting, putting it together. But it's the same process. Good? Alright. So let's then move on to Class 4. Alright. Class 4, risk and return. Primary thing we came up, this was the capital asset pricing model, and in particular, beta. How beta affected. Let's see if I can get to, or let's go back to this graph. Do you all remember this graph? We talked about the fact that stocks have a certain amount of risk. Some of that is market risk that is inherent that we can't get rid of. Some of it is diversifiable risk. We talked about the idea of combining assets to diversify away the risk. Because when one is having a bad year, the other might be having a good year. And as long as they are not perfectly correlated, putting them together will decrease the amount of risk, the amount of standard deviation of that combined portfolio. But the beauty of this is we're not sacrificing return. We still get a weighted average of the return even though we decrease risk. So we like combining portfolios. And as we put more and more assets into a portfolio, perhaps around 40 stocks, we get less risk, and we've diversified away all of the company's specific risk. What is left is the amount of market risk that we're taking. Taking a little market risk is not necessarily a bad thing, as long as we know what the risk is and we are compensated for it. So we can look at a couple of jokers like these two fund managers. Remember, we talked about fund manager CC and fund manager JJ. And they tried to sell us a bill of goods, or at least CC tried to sell us a bill of goods because CC is higher than JJ. As you can see, CC say, I achieved a better return. But we being smart finance students are going to say, well, wait a minute. We know about the capital asset pricing model. We know about the security market line. We know about beta. And we know that your portfolio had a higher beta. And that means you were a higher risk. So you should have earned more. In fact, you underperformed compared to assets of similar risk. And we're going to give the promotion to JJ, who overperformed compared to the asset comparable to assets of similar risk. And a few things we need to understand, the most important of which is probably the pricing model. Let's see if I can get to the formula here. Yes. Security market line gives us the return required on an asset. Starts with the risk-free rate. Anytime you're giving money to a company, there's a time value of that, even if it were risk-free. So the minimum you're going to start with is the risk-free rate. And then we're going to calculate the beta for this stock. If it's of average market risk, it's going to have a beta of about 1. If it's less market risk, it's going to have a beta of less than 1, more than 1. And we're going to multiply that by the risk premium that the average stock on the market demands. So the risk premium is the difference between the risk-free rate and the average market portfolio. And you will usually be given this, and you will calculate the required return. Let's see, what else did we have? No questions on that, right? What else did we have? Yeah, we talked about, I think those are the main things. That graph, this graph here, and understanding company diversifiable risk, market risk, and how we can combine assets to make a better portfolio. How we can use beta. And it's probably, you might have to calculate beta, but if you do, you just flip to that section in your slides. Say this is the beta. And how those two fund managers, JJ and CC, we can say which one took more risk and which one performed better based on our smart finance analysis. And lastly, I guess that's it. And then of course just calculating the actual return. All right. So let's look at the quiz questions that summarize all that for us. All right. Let's look at number 1. According to the capital asset pricing model, investors are primarily concerned with portfolio risk, not the risk of individual stocks held in isolation. Thus, the relevant risk is the stock's contribution to the riskiness of a well-diversified portfolio. True, false? True. Outstanding. Risk-averse investors require higher rates of return on investments whose returns are highly uncertain, and most investors are risk-averse. Truism. Diversification will normally reduce the risk of a portfolio of stocks. True is correct. Market risk refers to the tendency of a stock to move In the general stock market, market risk refers to the tendency of a stock to move with the general stock market. A stock with above average market risk will tend to be more volatile than an average stock, and its beta will be greater than 1. Truism. Absolutely. Make sense?
Yeah, I noticed you just sent an email to you before this.
Yes. Okay. Good. Any change in beta is likely to affect the required rate of return on a stock, which implies that a change in beta will likely have an impact on the stock's price. All other things are held constant. Is that true or false? This is true. So the beta affects the required return. And the required return is our discount rate we're using to discount those free cash flows. So we talked a minute earlier, half an hour ago, about calculating free cash flow. That's the money coming in. The question is, what number do we divide that by when we do our time value of money formula? Well, if we're using the capital asset pricing model for this particular stock, we're going to use that, and that's going to be based on beta. And if the beta increases, then that will change the return, and that will change the price. Good? One key conclusion of the capital asset pricing model is that the value of an asset should be measured by considering both risk and expected return of the asset, assuming that the asset is held in a well-diversified portfolio. The risk of the asset held in isolation is not relevant under the capital asset pricing model. True. Why is it not relevant under the capital asset pricing model? It's because the capital asset pricing model says, well, smart investors will invest in a well-diversified portfolio. And they're not going to compensate you for the risk of that one stock held in isolation. Because we can take that one stock held in isolation, and that actually might be a good thing, because it's going to counteract some of the risk in the rest of our portfolio. So we're not going to charge as high a rate for that one risky stock, because we know it might have value in a well-diversified portfolio. Not concerned under the CAPM. Good. Risk aversion implies that investors require higher expected returns on riskier than less risky securities. Yeah, true. Absolutely. Number 8, a stock's beta measures its diversifiable risk relative to the diversifiable risk of other firms. Stock's beta measures the diversifiable risk relative to the diversifiable risk of other firms. False.
That's what got me.
Diversifiable?
No, the question, like the way you asked it, like I didn't really pay attention because it's a trick question. Diversifiable.
Yeah, diversifiable risk. Beta is not concerned with diversifiable risk. Beta measures market risk. Diversifiable risk should be diversified away. Just think about it. It's diversifiable risk. Why not diversify it? A problem that can be solved. Good? Even if the correlation between returns on two securities is +1, the securities combined in the correct proportions. If the securities are combined in the correct proportions, the resulting two-asset portfolio will have less risk than either security held alone. That is false. Why is it false?
Because the correlation of +1 will not cancel the effect of other firms.
Yes. Key point is the correlation of +1. +1 means they're the same asset. They're either the same asset or they respond to the market in the exact same way. So it's just doubling down on one asset. So if If one asset has a crazy CEO who dies in a plane crash, then I guess the other asset is going to have a crazy CEO who dies in a plane crash too. Because they have a correlation of positive 1. They live in this world where everything identical happens to both of them. And we want assets that have a correlation of less than positive 1. The y-axis intercept. What is it? The x is on the horizontal, the y is on the top. And the security market line. All right, what do we have for the security market line? We had so for the security market line, we had beta, I believe, on the x-axis, and we had required return on the y-axis. So the y-axis intercept of the security market line represents the required return with a portfolio of 0, which is the risk-free rate. So the y-axis intercept, which means where it crosses the y-axis, is going to have represents a required return portfolio of beta of 0, which is the risk-free rate. True or false? True? Yeah, like true. So this is the risk-free rate, beta of 0. No risk whatsoever. Beta of 1 is average market risk. Beta of more than 1 is more than average market risk. And then we go all the way down to 0, which is no risk whatsoever, which we consider government treasuries. Good? All right, question 11. You are considering investing in one of 3 stocks. Stock A, B, C. They have various standard deviations. They have various betas. If you are a strict risk minimizer, you would choose stock blank if it's to be held in isolation, and stock blank if it's to be held as part of a well-diversified portfolio. This is a good summation question. So, which of these stocks, A, B, C, do you like the best in terms of holding in isolation? Holding in isolation, we're just looking at the standard deviation of that one stock, and we like it to be low. But if we're a wise investor and we're combining a stock with a well-diversified portfolio, which one helps us most in our quest to be risk minimizers? The beta is the key consideration, because that's going to tell us the contribution to a well-diversified portfolio. We want it to be low. We want it to be A. So the answer is BA. Good? 12. Which of the following is most likely to occur as you add randomly selected stocks to our portfolio, which currently consists of 3 average stocks? I'm going to take a look. Tell you the answer is E. The diversifiable risk of your portfolio will likely decline, but the expected market risk should not change. So as we add more stocks, diversifiable risk, i.e. risk that can be diversified, tends to go away. But we cannot eliminate the market risk. All we can do is quantify it and make sure we're being compensated for it. Good. Zacher Company stock has a beta of 1.4. Risk-free rate is that. Market risk premium is 5.5. What is the required rate of return? Let's do this one really quick, just to make sure we're fluent on this. All right. So we want to know, this is just the classic. And we may have to do this from different angles on the exam, but as long as we're clear on the basics, return of this individual stock is going to equal what? What's our starting point for this? Risk-free rate, yep, which is 4.25. 4.25 plus
Beta.
beta. And what's beta?
1.4.
1.4 beta times what? Market risk premium, which is what? 5.5? 5. All right. So that's just math. And if you calculate it out, what do you get? 11.95. Good? All right, let's see. Hopefully these last two are just more of the same. Megan Ross holds the following portfolio. What is the portfolio's beta? Let's think about this one for a minute. So we've got stock A, B, C, D. We have various betas for each of these stocks, and we have various amounts of investment. Now, how are we going to find the portfolio's beta?
With a weighted average.
Weighted average. Yes. Now the reason we can do a weighted average is because beta is scaled to the market. So this is all the oranges to oranges comparison. We don't have to worry about the thing we went over in class, whatever we did this, where the standard deviation, if we put them together, things are going to happen to lower that risk. This has already all been calculated out to be scaled to the market, so we just do a weighted average, and we come up with the answer. Good? All right, last one. Fishing Roof Supplies has stock beta of 1.32. Its required rate of return is 11.75. Risk-free rate is 4.5. What is the required rate of return on the market? Hint. First, find the market risk premium. So this is just one where we have to do a little more calculating, but we're still working with this same formula. Would anyone like to, you want to do this one? No? Okay, good. So we are past the we're right at the halfway point. I feel like the second half is going to go faster. Let's take about 7-8 minutes. All right, so let's come back at 8. So 8:06. 8:06. Yes, sir.
How many questions will we have in the final exam?
32.
What?
32.
I thought we were going to have more.
And it's our multiple choice.
It is multiple choice, true, false.
Everything?
No.
No.
You don't like false?
No, I think it's tricky. Oh, I thought we were going to do some calculations.
No, I'm sorry, but
Calculation is not true false.
They're all true false.
They're like where you have to plug the numbers in formula. And
Yeah.
do the calculation?
yeah, you do calculations.
Oh,
All
okay, okay,
test
okay.
calculations?
Just like
or-
the quiz.
Yeah.
Oh, I
Mostly
thought you
true.
were just saying it was a true or false
The
question.
test is about most of the calculations or the
Oh, like
stuff from
word
the
questions?
chapters, like rules.
I would.
I was like
We
solve
can't
the
bring the
problems
quizzes in
first,
with us, right?
so they're
Yeah,
easier.
can we quiz it?
Definitely, with everything else in
Yeah,
class.
every question.
Yeah, because as long as you solve it and you get an answer, you know if it's right or wrong. But the questions, don't forget it.
Well, I mean, I feel like you should be able to understand based on our review. If you have more questions after class, I can definitely explain them further. But it's just important we have the intuition, this basic bottom line. I won't say basic. I'll say this bottom line understanding, which will make us confident. We're talking. When we bump into the Columbia MBAs talking about their job on Wall Street. We say, well, I know. We diversify with this. So yeah, 32 questions, maybe the 5 or 6 true false, the rest multiple choice. And of the multiple choice, most of them are calculations, some of them are periodic rates. But some of them are like wording, like, what's this, what's that. Okay.
And 1 word for the final exam, right?
What's that?
The 1 word, we have to use only 1 word for the final exam.
One word?
Hour?
Oh, no. I think I said 2.5 hours on the syllabus, but if I find no one's done, you can take the full 3 hours. But think it'll probably take 2 hours. All right, so let's move on to the next chapter. In the next chapter, we put all this stuff together, put a lot of the stuff together, and we calculated the weighted average cost of capital, which is going to be our ultimate discount rate for these free cash flows. Weighted average cost of capital considered the debt, preferred stock, equity. The debt was the easiest. And let me start this way. The weights was the easy part of this. And on the exam, you'll be given, this is how much debt a company has, this is how much preferred stock, this is how much common stock it has. And you can calculate the weights just by doing the math. You'll also need to calculate the discount rate. For debt, it will pretty much always be given. There's not going to be any trick questions like, this is how much the market rate of debt is, this is how much it was a year ago. It will usually just be given. And you, of course, need to remember the tax benefit from debt, which lowers the effective rate that you're paying on your debt. Preferred stock. Remember we calculated preferred stock based on a dividend. We talked about how preferred managers like to pay a consistent dividend for preferred stock. So if you have a preferred stock worth $100 and you pay $6 preferred dividend every year, you're paying 6% on that stock. And one little kink with that is suppose you have to pay some flotation costs. Suppose of that $100 that a preferred stock costs, you have to pay a broker $5, you only get $95 of it. So you're paying $6 on $95 every year, which is going to make the cost a little bit more. That's the way and I'll scroll to that part in a minute, that's the way we calculated the cost of our preferred stock. And for the cost of common stock, what was the main way we used to calculate the cost of that? I guess, well, there are two ways. I'm going to ask you, we don't have to distinguish main way right now, just what are the two ways we use to calculate the cost of stock, cost of common stock?
Risk-free rate?
Yeah, the capital asset pricing model in the security market line, which is this. This is a very common way to calculate the cost of stock. The other way is the exact same way we calculated the preferred stock, which is just assuming a dividend. We use that discounted cash flow method. Let me scroll to those right quick. Okay, preferred stock formula. So what's it cost? How much money do we need to raise on our various projects or generate through our business ventures to keep the preferred stockholders happy? Well, let's consider the dividend we pay versus the price they paid us, how much money they gave us to run our company, subtract off flotation costs. For the cost of equity, common equity, as Sharmista pointed out, we can use the capital asset pricing model. We can also use a similar version of the preferred stock discount cash flow model. We just need to add this growth aspect. Because common equity holders, not only do they expect a dividend every once in a while, or they may or may not, but they will definitely expect their stock to grow in value. Grow in value the same way we just talked about the growth that the portfolio manager JJ and CG were expected to, JJ and CC were expected to achieve based on the amount of risk they're taking. Investors are going to demand that kind of growth, so we add that in. I think that was the main crux of the cost of capital, all the components of weighted average cost of capital, and how we can calculate those as necessary. Let's take a look at the quiz. Company's preferred stock currently sells for this much, and it pays $8 annual dividend. The company were to sell a new preferred issue would incur a flotation cost. What is the cost of preferred stock? How are we going to calculate this one? We're going to use the capital asset pricing model. No, it's kind of a trick question. Kind of a joke. We don't use the capital asset pricing model on preferred stock. Preferred stock, we really only have one way, which is that discounted cash flow. We know that we need to pay an $8 dividend every year. We know that the amount of money the investors are investing in our company is $92.50. We also know the broker takes a little piece of that. So let's do it right here. So we know, so let's take $8 divided by $92.50 times 1 minus 0.05. It's going to tell us how much return we're going to need to generate to consistently pay that $8 at the very least. What's that?
9.10.
All right. Like how I did that? Like that touch, huh? Does that work? All right. Excellent. Adams has the following data, giving us the risk-free rate, the market premium, beta. What is the firm's cost of common from reinvested earnings based on the CAPM? We're going to solve this with the capital asset pricing model. We're going to take our 5% plus 1.05 times 6%. That's going to give us the answer. We don't need to do any more than that. We're good. Let's see. As a consultant of BaseSo, you have been provided with the following data. Dividends, D1, 67 cents. Note that D1, P0, 27.50, G, 8%. What is the cost of common from reinvested earnings based on the discounted cash flow approach? How are we going to solve this one? We need to use a discounted cash flow, which is the amount of dividend divided by the cost of stock. We might need to consider flotation costs. We might also need to consider growth. All right, so there's D1, that's dividend a year from now. And that's the number we want to consider. And if we're not given the dividend a year from now, we need to consider the growth. Because we know today, an investor is going to buy our stock for $27.50. That's, you could think of it, that's how much money they're giving us. And we need to generate enough return to at least give them 67 cents, preferably more, and account for their expectations of growth. So divide by 27.50. There's no flotation costs. We're good there. Plus 0.08. And that should give us the right answer once we calculate it out. Right? All right, we're good there? Assume that you are an intern for Bracton. What is the firm's WACC? Alright, assuming it must issue new stock. So, yield on companies' outstanding bonds. That sounds like something that's going to give me cost of debt, right? Tax, we know there's a benefit to cost of debt, so we're going to calculate that. And we're given dividend per share. We're given the dividend growth rate. And we're given the price of stock, so we know we're not going to use the capital asset pricing model to consider the cost of equity. We're going to use the discounted cash flow like we just did in the previous problem. There's some flotation costs in that discounted cash flow. We've got the target debt structure, so we've got the weights. So we've got the weights, we've got the cost of debt, the tax rate, and if we do a little work, we could pretty easily have the cost of equity. And we just crunch it out. Good? All right, so question 5, we're looking for WACC. It gives us a capital structure, debt, preferred, equity. It gives us an after-tax cost of debt. So what's the significance of that? Giving us this after-tax cost of debt. Does that make it easier for us or harder for us? Well, let's come back to that. It's looking at the other two. It's giving us the cost of preferred and the cost of common. So that looks good to me. We know that the cost of preferred is 7.5. The cost of common is 12.75. We have the weights. Only question is, what is this after-tax cost of debt? Do we need to make an adjustment to that? Or is that the number we use? That is the number we use. Now we have a big clue that they don't give us the tax rate in this question. You know, there's no tax rate given in this question. So if they wanted to be really mean, they would have given us the tax rate in this question. And then we would have had to really think about it. But they didn't even tempt us with that. So this is the number we use. We just put it in the weighted average cost of capital. And we're good. The cost of capital used in capital budgeting should reflect the average cost of various sources of long-term funds the firm uses to acquire assets. Sounds good to me, right? This is a trick question, and I'll feel bad. True. Answer is true. Component cost of capitals are market-driven variables in the sense that they're based on investors' required returns. True, yeah. So, you know, the cost of debt, cost of equity. How much are investors demanding? Well, that's how much we're going to have to earn in order for them to like us. All right, question 8. The before-tax cost of debt, which is lower than the after-tax cost of debt, is used as a component in the debt for purposes of developing the firm's WACC. All right, we know it is that the cost of debt is used for developing a firm's WACC. We know that. The trick here is, do we want the before cost of tax of debt or the after-tax cost of debt? Yes, we want the after-tax cost of debt, and then the other thing is, which is lower? Is the before-cost tax of debt lower, or is the after-tax cost of debt lower?
I mean, after tax.
Yeah, the after-tax cost of debt is lower because we get a tax advantage for debt. So after-tax cost of debt is lower. So sorry, Irina, it's one of those tricky ones. This is false because after-tax is lower, not the before-cost. All right, question 9. Funds acquired by the firm through retained earnings have no cost because there is no dividend or interest payments associated with them, and no flotation costs are required to raise them. But capital raised by selling new stocks does have a cost. So retained earnings, we can just use that. We don't have to generate a return on it. That's what it's saying. Is that true? That is. What do you think, Venetia? No, that is false. Even though we have the money sitting in our bank account, our investors are going to say, you better earn our return on it or give it to us in a dividend or something like that. That is false. All right, a firm's marginal tax rate. If a firm's marginal tax rate is increased, this would, other things held constant, lower the cost of debt to calculate its WACC. Tax rate goes up, cost of debt goes down. Is that true? Yeah, it's true, because debt has a tax advantage. So the higher the tax rate, the more we would be inclined to use debt. We may not be happy about paying a higher tax rate. Alrighty. Excellent. And again, if I'm going through any of this too fast, just slow me down. Say, hey, work that one out. So let's move on to class 6. Alright, I believe this was our various capital budgeting metrics. NPV, IRR, modified IRR, profitability index, payback, discounted payback, unequal lives. So when we got to this point, we had already done the calculations and we had already thought in terms of NPV. We just had to call it NPV. Net present value is adding up the present value of the cash flow, present value of all the cash flows, including our initial investment. This is, in theory, the best way to evaluate the strength of the project. It tells us how much this future project is worth in today's terms, in actual dollars. IRR is also a valid calculation, which is going to give us a similar result to NPV, but there are some confusing issues when we're looking at both NPV and IRR. So remember the problem, I'll give you a hint, there's the crossover rate, there's the being dependent on cost of capital that we just need to keep in our heads as we're explaining this to our investment team or our manager. All right, it was that NPV is dependent on the cost of capital, the WACC. All right, we're going to calculate a WACC, and then we're going to calculate NPV. And depending on the figure, the WACC that we calculate, that's going to tell us, that's going to inform what the NPV is. So if we made a mistake calculating that, if the market conditions changed, then that's going to affect the quality of our answer. The IRR just tells us the rate of return. It's independent of our WACC calculation. And one thing to note about the NPV, do you remember how a higher WACC penalized projects that had cash flows that came later? So cash flows that came later we're in a sense penalized by a higher weighted average cost of capital. Cash flows that came sooner, we're not penalized so much. Profitability index. Anyone remember what that one was? Present value of future cash flows divided by the initial cost. If you're asked to calculate on that on the exam, just flip to that. Note that you will put all the future cash flows in present value and then divide by the cost. Payback period. What's the payback period?
Get your money back.
How long does it take you to get your money back? Do we put those cash flows in present value terms? We do not. It just gives us a crude measure. How long is it going to take us to get that initial investment back? Potentially could be useful information. Could be useful to people who are not as finance savvy as you all are. To make it a little more financially accurate, you could use the discounted payback. Discount. Whatever. Discounted payback, which just means you put the future cash flows in present value terms, and then you calculate how long it's going to take you to get your money back in present value terms. And then unequal lives, we talked about one project maybe being 4 years, another project being 2 years. In order to make a true apples to apples comparison, we could repeat the 2-year project and calculate the NPV of that and compare it to the NPV of the 4-year project. Any questions? All right, let's fire through these quizzes, quiz questions. Okay, a basic rule of capital budgeting is the project NPV exceeds the IRR, then the project should be accepted. True or false? False. Yes. All right. Do you want to make this question true? What do we need to put in? They tricked you because it sounds like something that is true.
That's true.
Yeah. Okay. So what do we need to put in there instead of IRR to make this true?
Oh, 0?
Starts with W, ends with C. Right. If a project's in, oh wait a minute. No, I'm sorry. The basic rule of capital budgeting is that the project's NPV exceeds 0. I'm sorry, Jing. Oh my God, my bad. Sorry, I needed another sip of coffee to get this one. So Jing was right. If a project's NVP exceeds 0, it should be accepted. All right, we're good on that? If the IRR of project X is greater than the IRR of mutually exclusive and also normal project Y, we can conclude that the firm should always select X then rather than Y. Take a look at that, I think. IRR of project X is greater than the IRR of mutually exclusive project Y. We can conclude that the firm should always select X rather than Y.
It's not always.
Not always, because remember we talked about the NPV may give us conflicting information. In which case we just need to account for that. We need to explain to the investment team. Well, the NPV says one thing, the IRR says another thing. Let's think about whether or not we've calculated the NPV correctly. Let's consider all these factors carefully before we move forward. Right. The project's IRR is independent of the firm's cost of capital. In other words, the project's IRR doesn't change with the firm's cost of capital. True. That is true. That is IRR independent of cost of capital. NPV is dependent on cost of capital. Like we discovered in the previous question, if we don't get it right, then it may give us a different answer than IRR. Assuming that NPVs based on the firm's cost of capital are equal, the NPV of a project whose cash flows accrue relatively rapidly, soon, will be more sensitive to changes in the discount rate than the NPV of a project whose cash flows come later in life. So this is saying, we've got a project whose cash flows occur rather rapidly, and it's saying that one is going to be more sensitive than a project whose cash flows come later in life. Is that a true statement? This is false. So it's the opposite. The cash flows that come earlier are more sensitive to changes in the discount rate. No. Cash flows that come later are more sensitive to changes. All right. Conflicts between two mutually exclusive projects occasionally occur, where the NPV method ranks one project higher and the IRR method ranks the other first. In theory, such conflicts should be used with the project with the higher NPV. That's true. So NPV is theoretically the best way to make the decision on which projects. The only thing is you need to consider whether or not you've got the WACC calculated correctly. But if you have, that's theoretically more money. Think of those Jimmy Fallon credit card commercials that came out a couple of years ago. Because everyone wants more money. He was talking to the baby. So yes, more money is good. NPV directly measures money. Question 6. Assume a project has normal cash flows, all else equal, which of the following statements is correct? I will tell you the answer is A. A project's NPV increases as WACC declines. So lower discount rate means higher value, right? Good? All right, what do we got here? Considering the project has the following cash flow, what is the project discounted payback? So we have an initial investment of $900, then we got 500 in year 1, 500 in year 2, 500 in year 3. So this is not just the payback, this is the discounted payback. So we want to discount these 3. And you could do this on the exam. You wouldn't need Excel for this, right? You could discount these 3, put them in present value terms, and then determine when you're going to get your $900 back in present value terms. All right, it's considering a project has this cash flow and WACC data. What is the NPV? You know what the project is expected to do. Considering this project has the following cash flow and WACC data, what is the project NPV? Note that the project expected NPV can be negative. So we've got WACC, we've got cash flows, initial investment of $1,100, then we've got $400, $390, $380, $370, $360. So this is just the time value of money. We discount all these back. You won't have to do one that has 5 years, but you might have one that has 3 years. And you just discount this 1 year, discount this 2 years, discount this 3 years, so on. Add everything up, get the right answer. All right, gamer, blah, blah, blah. What is the project's payback? All right, so it's asking payback, not discounted payback. So this is easier. We know we need to get We initially invest 300. The first year, we get 200. The second year, we get 200. The third year, we get 200. So around where does the payback occur? Between 1 and 2? Yes, so we know we need 150 after year 1. So 150 divided by 2 is going to give us the fraction of year 1 that we need. Divide 150 by 200. That's going to give us the point. So it's going to be one of these. 1 is going to give us the point. Is it this one? Yeah. 175? 1.75? Right. All right. Park Corporation. Da-da-da. What is the project's IRR? So you won't have to calculate IRR because you can't really do that. Can't really do that on the exam. But you may have to answer a true-false question about IRR. Sorry. All right. Let's move on unless there are any questions. Chapter 14. Yes, absolutely. Yes. On the payback? Yep. Yep. Oh, so, alright, so this is the same one. We just answered the initial investment of 350, and then you get 200 in year 1, 200 in year 2. So after year 1, so you invested 350. After year 1, you've been paid back 200, so you're still out 150. All right, and then at the end of year 2, you're going to be paid back 200.
Right.
So you know at the end of year 2, you're going to be completely paid back,
Okay.
plus $50. The question is, when between year 1 and year 2 do you hit that magic I've been paid back all 150? And how we do that, as we say, so our payback period is, so payback, back. We know it's 1 year plus something. It's 150 divided by 200. Because you know over the course of the second year we're going to get 200. And we want to know how much of that year before we get 150. 150 divided by 200 is 0.75. So we know our payback is 1.75 years. Okay? Okay. All right. So then in class 7, I believe we talked about distribution to shareholders. Distributions in the form of dividends. Distributions in the form of stock repurchases. A couple important things with that. Let's think about how they affect stock price, first of all. And let's think about the signals that dividends send to the market and repurchases send to the market. First, in terms of dividends, how does a dividend affect a stock price? It lowers the dividend. It lowers the price. You're just giving part of the profits, part of the money to the investors, so the stock price will decrease. Dividends also send a signal to the market. And I guess we'll get to that. There's a number of nuances there. Let's talk about that in a minute. Repurchases. Do repurchases affect the price? And what effect do repurchases have on a stock? Just mathematically, do they affect the price?
No.
They do not. They're just repurchasing it. The shape of the pie changes, but the value of any stock that's still out there remains the same. So dividends affect the stock price. Repurchases do not. But there's some issues we need to think about with the signaling. We need to think about what investors might want in terms of dividends, not dividends. So investor preferences, remember we talked about 3 investor preferences. 1, dividend irrelevance. Investors don't care. Can someone break that down for me? Why would investors not care about whether or not you give them dividends? They want cash, they sell the stock. They don't care. You don't have to give them cash. And what if you do give them a dividend and they didn't want it? So you use the dividend to buy more. Yeah, that's one reason why investors may not care. What about investor preference, bird in the hand theory? What is that? A dividend preference, excuse me. Higher payout, give us the money now. You know, especially if we're in a country that doesn't have investor protection, give us our money before it might disappear without us noticing it. Tax effect, investors prefer a lower payout because capital gains is taxed at a lower rate than dividends. So if you give them a big dividend, they may have to pay a higher tax on it. If you let the tax, keep that in the value in the company, let it grow, capital gains taxed at lower rates. The empirical evidence on those three theories is mixed. It's just important you understand them. Another effect we need to understand, which does have a little more empirical basis, is the clientele effect. Certain clients will gravitate towards a company that pays out the way they want, that suits their investment needs. If they're a company that likes cash and dividends, then they're going to gravitate towards a company that pays dividends. If they want growth, they're going to gravitate towards a company that does not pay dividends. Signaling hypothesis. All right, now what is the crux here of the signaling hypothesis? I know we talked about a lot of signals in these last two classes, and it got a little bit confusing, but dividend changes are a signal of the company's future. So if a firm announces a dividend, they're unlikely to want to decrease that dividend in the future. So the market would get really excited when the management company says we're going to pay a dividend. So that's a very positive signal. The other side of that is a company might be reluctant to announce a dividend because they know they're going to have to maintain it in the future. Otherwise, cutting the dividend is going to send a negative signal to the market. All right. The residual distribution model you found out on the quiz was pretty much the only quantitative thing I could test you on this material. Can someone explain the residual distribution model for calculating how much dividend we want to pay? How does that work? I'll go ahead and put it up there. You can just read it and think about it. All right, so we've got our total capital budget distribution here. That's how much dividend the company might pay. We've got our total capital budget here. Target equity ratio here. That's maybe the first step of the calculation. And we're going to subtract that off the net income. And we're going to give the remainder in a dividend. So looking forward, we might say our capital budget is $100 million. We're a 70% equity company. So we're going to finance that capital budget with $70 million, 30 million debt. Suppose our net income was $120 million. Subtract off the amount of equity we need. It's going to leave us with, say, $50 million paid out in a dividend. That is a basis for deciding dividends. It's not something we need to religiously follow, because if we do, fluctuations in our net income, fluctuation in project availability may send confusing, conflicting signals to the market. So we need to know how to calculate it for a rough estimate of a good dividend to be paying, but we don't necessarily need to follow it. And I think that was it, right? We did some of the math of the before and after. You should be roughly familiar with this. Stock splits, stock dividends. All right, what's a stock split? And how does it affect value?
The stock split is when, I guess, stock reaches and stock the exact number, but I guess when it gets to
It gets large.
So they decide to split it.
They decide to split. Why do they decide to split? Because they want to make it twice as large?
Well, no, because it's still the same value for the shareholder. For shareholders, they still have the same value. It just
Now you have 2 stocks instead of one, because might be in an easier range to buy and sell. Optimal trading value. So it sends a signal that management is expecting an increase in stock value, but the actual mathematics of it, you don't get more just because a company's stock splits. Stock dividends are the same way. It's just a different iteration of a split. It's not an exact split. Okay, good. I like it. Chapter 14 quiz. All right. If investors prefer firms that retain most of their earnings than a firm wants to maximize its stock price, it should set a low payout ratio. Yes, I like it. Investors prefer firms that retain most of their earnings. They should set a low, because of the clientele effect. Yes, true. Number 2, if the information content or signaling hypothesis is correct, then changes in dividend policy can have an important effect on the firm's value and capital costs. Yeah. And that's what the signaling hypothesis says, is that the announcements you make with regard to distributions affect the firm's value. All right, number 3, stock splits and stock dividends should at least conceptually have the same effect on shareholders' wealth. Stock dividends and stock splits should at least conceptually have the same effect on shareholders' wealth. True. It's, we're not changing wealth with a stock split. Number 4, if management wants to maximize stock price and if it believes the dividend irrelevance theory is correct, then it must adhere to the residual distribution policy. Want to maximize stock price, and it believes that investors don't care what the dividend is. That's what the dividend irrelevance theory is. Investors don't care. Then it must adhere to the residual distribution policy. False. Investors don't care, so it doesn't have to adhere to that policy. If investors cared, then they would have to consider something else. Does that make sense? Yeah. All right. Brinkley Resources stock has increased significantly in the past 5 years, yada yada. All right, this is just a dividend, right? It wants to split. It's $175 now. It wants to split it down to 75. $75 per share. How many times does it need to split? Yeah. So it's $175 now. The management wants it to be 25. How many times does it need to split the stock? 7 times. Good? All right. David Rose forecasts a budget of $500,000 next year. This is residual income model, right? The company follows the residual. Yeah, I think all these were because, like I said, this was the only quantitative thing I could really test you on. So, are we good on that? Do we need to calculate that out? No. All right. I think this is the same. Residual. This is another residual. Firm adheres to the residual. All right. Number 8. If the firm adheres strictly to the residual dividend policy, the issuance of common stock would suggest what? Let me give you the answer and we'll discuss it. Oh, you got it, Frida? No dividends were paid out during this year. Yeah, so the firm adheres strictly to the residual dividend policy. Issuance of new common stock would suggest, yeah. So if they're actually issuing stock and asking more investors for more money, then they certainly didn't give out dividends during that year. Make sense? 8. Puff Industries is currently selling stock at 120 per share. You have 100 shares. The company is contemplating a 2-for-1 split. Which of the following would best describe your position after such a split takes place? Somebody have the answer for us? The answer is A. You will have 200 shares of stock and the stock will trade at $60 per share. Yeah, so you've got 100 shares of 120 right now, a 2-for-1 split. You're going to have 200 shares, they're going to be worth half as much. All right, question 10. Residual dividend. This is residual distribution policy. We don't need to do it, do we? Okay, excellent, excellent. All right, roll out the shoulders. We're on the last class. And this one, I really like this material in the last class. It's the intuition that I think is exciting to think about. Let me go ahead and put the screen down for this one. Alright, so how did capital structure affect the value of the firm? Alright, we talked about business risk versus financial risk. Business risk is just risk that a business has. Will its product sell? Will it lose a big client? Will there be political unrest in Mexico that's going to disrupt the factory process there? Normal business risk, we thought of. Financial risk is something else. Remember we went through that example of investing, I think investing $1 versus investing $1 and borrowing another $1. It was $10, right?
Yeah, it's 10.
Invest $10 of your own is option 1. Invest $10 of your own plus borrow $10. And which one was more risky? Yeah, one where you borrow the $10. It magnifies the risk. So that's financial risk. The extra risk you're taking, additional risk concentrated on the common stockholders when financial leverage is used. Financial leverage means debt. More debt equals more risk. So we talked about this impact on returns. More risky with the levered firm. Capital structure theories. First started with the MM theory. Corporate taxes, no taxes, trade-off theory, signal theory, pecking order. All right, let's fire through these. So what's the MM theory? Well, MM theory with 0 taxes. These two finance people calculated that a firm, if there were no taxes, we would receive no benefit from more debt. Therefore, the amount of cash flows going to the owners of the firm would be the same in a levered situation and an unlevered situation. So assuming no taxes, MMM said the values of the firm are equal. But we know that's not true. There are corporate taxes. Given that there are corporate taxes, we get a benefit from either debt or equity. Which one? Debt. We get a benefit from debt. So that being the case, firms would be more likely to use more debt. And we also talked about the idea of debt being more attractive because there are more assurances to debt holders. Debt holders get their money back first in the event of bankruptcy. Debt holders get guaranteed interest payments. Equity holders do not. So, in terms of the tax effect, M&M said we get this tax effect, so a firm should use as much debt as possible. That's where they stopped their analysis. And then we said, well, hey, wait a minute. What if you have all this debt? Doesn't it increase your financial risk with that scenario 1, scenario 2 example we use? And doesn't that potentially hurt us? Yes, it does. and it's going to give us the trade-off theory. And I like this graph, which told us this is the value of the unlevered firm. As debt increases, the unlevered firm stays the same. As debt increases, the tax shield for a levered firm increases. Just gets higher and higher, gets better and better, because the more debt you have, the more tax shield you have. Problem is the risk of bankruptcy. As you get more and more debt, the chances of financial distress, chances of bankruptcy increase, which is going to result in a decreasing value of your firm. As you add more debt, value of your firm goes up. All right, but then the risk of financial distress gets so great, it starts eroding the value of your firm. We want to find that sweet spot right there. In fact, we might even want to be a little further back on that sweet spot. Why? Yeah, reserve borrowing capacity in case some investment opportunities come up. Because we talked about the idea, what if we're right there and we have some investment opportunities come up and we borrow a lot, we're going to start eroding our value. We also might be reluctant to issue new equity, because if we issue equity, what sort of signal might that send to the market? We're selling equity, we're going to give more shares. All right. It has to do with the selling equity and the price of stock. It's overvalued. Okay, we're selling it, it must be overvalued. Why else would you try to sell it to me unless you think it's worth more than you want me to pay for it? Or you think it's worth, it's overvalued. We'll just stay with that. Okay, signaling theory. Just as Danil said, stock is, if we sell stock, the market's going to think it's overvalued. If we sell bonds, which means we issue debt, that means we think our stock is undervalued. Investors know this, so they view new stock as a negative signal. So this leads us to the pecking order theory, which gives us a 3-step process of how managers will often choose to fund new projects. Pool 1, investment pool 1 is what? Retained earnings, yes. Option 2 is what? Issue debt. Option 3? Yes, outstanding. Alright, I'll skip that. We talked about opportunity set, reserve borrowing capacity. Now, I mentioned that you as financial consultants are just going to have an understanding of all these different theories and know which one to pull out of your pocket at which time, because the market timing theory says something completely different. And what does the market timing theory say? That it might be smart for investors to do, or managers to do. Issue stock when the stock is high. And try to make a good case for it. Say, no, it's not overvalued. Look at this article that Fortune 5, or Forbes magazine wrote about us. Look at this person who's endorsing our product. You might try to bridge that, what the textbook called asymmetric information problem. Try to convince the stock market or convince the investors in the market that it's okay. Empirical evidence, we don't need to go through all that again. We went through this example towards the end where we said, let's reconfigure our capital structure. And I think I'm going to go, let's see, yeah, I'm going to go to that chart. That is what I want to do. And I think that could wrap up everything for us. That chart, maybe that chart, maybe the other chart. Yes. I want to go to this chart. Okay, so this chart is saying, let's consider various options for a different capital structure. Let's consider the weight of debt. What if it were zero debt, 100% equity? The weight of stock, 100% stock, 0% debt. Well, what if we had 20% debt, 30, 40, 50% debt, and a corresponding change in the weight of stock? So let's look at this first row here. This is the cost of debt. As we introduce more debt into our company, what is happening to the cost of debt and why? All right, so just read these numbers, tell me the trend. That's the first step, and then tell me why.
Increasing
It is increasing. Why?
because I guess as you add more, it's becoming more risky as you add more debt to.
Risk. Risk. We use that example. Scenario 1, where you invest your $10 and borrow $10, that increases the risk. Possibility of bankruptcy, financial distress. All right, beta. So this is the company's beta. So this is beta, which determines the cost of equity. What's happening to this row and why? Janelle? Yes, why? Yes, outstanding. Same thing. All right, it's increasing for everybody. This boat is getting a little more risky. Let's find the optimal amount or just a little risk and not too much more. Now, note you may have to recalculate betas, and you can do this. There's a slide, I think maybe 10 slides before this. I think it's called Hamada's formula for the beta of a levered versus non-levered. What's that?
That's the thing. That's the beta BU.
Yeah.
Yes, this is beta. This would be beta levered. So this would be beta unlevered. This would be beta levered. Beta levered, beta levered. So for every calculation, you would start with the beta unlevered, and then say, all right, how much more risk are we taking? What's the weights? Use plug and chug in the formula, and you're going to get a new beta that's going to increase as you add more debt because, as Danelle pointed out, more risk. And the beta is what we'll use to calculate the cost of stock. Cost of stock goes up. Now, that brings us to the weighted average cost of capital. What is happening to those numbers as we go from left to right, and why? All right, decreases is wrong. What happened there? Did that decrease or increase?
There's a point which is minimized.
Yes, so yes, there's a point where it memorizes. It decreases here and then increases here. Now, why does it decrease here and why does it increase here? And why is it important for you, as the financial consultants who are telling this management team how to maximize the value of their firm? Well, this is the game we're playing, right? We're trying to decrease WACC so that we can increase value. And by adding more debt, we get the benefit of the tax shield of debt. We get the benefit of debt being lower cost because debt holders have more assurances. But that only works to a certain point. When we put on more and more debt, the risk increases so much that WACC goes back up. We want to find this sweet spot right here. So as we go from column 1 to column 2, we have introduced 20% debt before we had no debt, and we've decreased our WACC. Why have we decreased WACC? This is just the two reasons I gave you 30 seconds ago. Not a trick question. Tax benefit. We use more debt, we get a tax benefit. And also the cost of debt tends to be lower because debt holders get more assurances. But we can only play that game so long. So this would be a way to maximize the value of the firm. We might want to keep it right there for that sweet spot. give us a reserve borrowing capacity so we can borrow as necessary. All right. Let's begin the Chapter 15 quiz. Alrighty, let's take a look. Different borrowers have different risks of bankruptcy, and bankruptcy is costly to lenders. Therefore, lenders charge higher rates to borrowers judged to be more risk of going bankrupt. True, of course. If you're greater risk of going bankrupt, we're going to charge you more. Financial risk refers to the extra risk stockholders bear as a result of using debt compared with the risk if they would bear if no debt were used. True. Financial risk is the risk associated with debt or extra debt. A firm's capital structure does not affect its calculated free cash flows because free cash flows reflects only operating cash flows. A firm's capital structure does not affect its calculated free cash flows.
It's false.
That is false. Free cash flows, remember we take NOPAT, we subtract off the investments in operating capital, and we want it pre-interest payments. We want to figure that is cash flow going to both the debt holders and equity holders. What's that? Number 3 is false. Or no, it's true.
No, it's
Excuse me.
true.
It's true. It's true. My bad. Capital structure does not affect free cash flows. Okay, good. The trade-off theory states that capital structure decisions involves a trade-off between the costs and benefits of debt financing. Yeah, trade-off between the benefit of debt financing and the risk of going bankrupt if you use too much of it. Which of the following events is likely to encourage a company to raise its target debt ratio, all things held constant? Let me tell you the answer to this, and we'll talk about why. The answer is the last one, an increase in the corporate tax rate. So which of the following events is likely to encourage a company to raise its debt ratio, all things held constant? And I think there was a question exactly like this, but asked in a different context earlier on the material. It's the same thing. Tax rate gets higher, we get more benefit from debt. Number 6, which of the following statements is correct? The answer is the middle one. Increasing the company's debt ratio will typically increase the marginal cost of both debt and equity financing. So remember, because of risk, debt cost goes up, equity cost goes up. But this action may still lower the company's WACC. Why? Because of risk? No. It goes up because of risk. Why does WACC go down?
The tax benefit.
Tax benefit and the fact that debt holders have more assurances make the cost of debt lower. So the WACC could go down even though the risk goes up a little bit. We just need to find that sweet spot. All right. Number 7, based on the information of Benson Corporation, what is the optimal capital structure? I'll let you all look at this and tell me what you think the answer is.
I didn't understand that question.
All right, who thinks they have an answer?
It's the second one.
B. And why is B correct? The second one.
Well, it has the highest stock price.
Yes, highest stock price, which means the highest value, and it must have the lowest WACC. Now, where it gets confusing is these earnings per share. And why the answer is not the middle one is because we could change the capital, when we change the capital structure, we may have fewer shares, and the stockholders that remain may get more earnings for each individual share. There also might be a stock split. We could do a stock split, and that would change earnings per share. But that didn't change value. We want an actual stock price. I guess I shouldn't throw in stock split because that would confuse things, but we want the stock price which would reflect the overall value of the company. The number of shares could change, and it's an apples to oranges comparison. All right, Bailey and Sons has a levered beta of 1.1, and its capital structure consists of 40% debt, 60% equity, tax rate of 40%. What would its beta be if it used no debt? So this is just using the unlevered beta formula. Flip to the formula, crunch it out. All right, number 8. The following. Quick, we're good on that. The following information is presented to you about the Gibson Corporation. Okay, let me skip to the end. The company makes this change. What would be the total market value? Okay, so what's going on here? So we've got information about total assets, operating income, interest expense, net income, share price. The company has no growth opportunities, fine. Pays out all of its earnings as dividends. The consultant believes that the company moves to a capital structure with 20% debt and 8% equity. The cost of equity will increase to 11%, and the pre-tax cost of debt. All right, so we're given a lot of good information here. We know that if there's a change in capital structure, we don't have to calculate it. We're given the cost of equity is going to increase to 11% and 10%. So with that information, 11% and 10%, I think we could calculate the WACC, right? We calculate the WACC, then we just need the free cash flow, right? So I would calculate the free cash flow by taking EBIT, taking out taxes to get NOPAT. And this gets a little complicated because you have to do it twice. You have to calculate it based on the figures up at the top, what the value is, and you have to calculate it based on the change, and then tell them the difference. So it's not an easy problem, but it's one we could do if we worked it out carefully. Do we want to do it? No? No? No. Even if you need to, you don't want to, because it's hard. But anyway, yeah. So don't be intimidated by that. We could calculate all those things as necessary. Hopefully, you all did earlier today or earlier this week. Morales, number 10. Morales Publishing. Tax rate is 40% and its beta is 1.1. It uses no debt. However, the CFO is considering capital structure with 30% debt. So currently we have no debt. It's considering 30% debt. We know the risk-free rate of 5%, market risk premium is 6%. By how much would the capital structure shift the firm's cost of equity? So this is just an levered beta problem. We plug it into that formula. We know the beta now is 1.1, and we know that if we add more debt, it's going to be a higher beta. So we're going to have a new beta after we plug it into the formula. And then we're going to use the capital asset pricing model with the risk-free rate time plus the beta times the market risk premium to give us the new. Any questions? All right, I saw some eyes dozing off, but I tried to keep it as entertaining as possible. Hope that review was helpful. Yep. Fantastic. I'll be around if you have any individual questions. Look forward to seeing you all next week.
Thank you.
Thank you, Carlos.
Over 80. So far,
Is it over 80? Over 80? Sorry, I turned off the computer, but I feel like you're going to be in good shape.
your monthly, like a 1.5.
Oh. Send me an email and I'll reset that quiz for you because please remember each person gets to reset
Okay, I
one
got it. I
quiz.
will send it.
Okay.
Okay.
So send me an email, I'll reset that, you just take it.
Okay.
Just put in all the right
And
answers.
the other is 7 or 7 or 8 or 10. And then 2, 10.
Okay. And just be sure, like I said,
Yeah.
concentrate on doing as well as you can on the final, which is going to be based on quizzes, and that's going to be weighted more heavily. If I can see anything.
Thank you.
All right. Thank you.
Time value of money. Sorry about that.
Time value of money
Yeah.
tables?
Yeah.
Well, show me those if you see them. If you're not sure.
You never seen it before?
I'm sure I may have seen something like that.
This is
Oh crap! One second, Mark. How you doing? You feeling good? Oh, okay. You feeling good on this material?
Most of it. Some
Okay.
of it, I gotta like go through all the quizzes again.
Yeah, and just focus on the quizzes. Like all the quizzes, that should be the center point of your review and your study. And
You said we could see the we could go up and see the old quizzes again.
yeah, you should be able to
If you select the score that you got.
Oh, okay.
select the story. And yeah, if you have any problems, send me an email. That's how I studied for all my classes, for my exams in business school. I just looked at those homework questions over and over again. Basic questions over and over again.
exactly same. No.
It's not exactly the same, but it's very, very
Just take those questions and mix it up a little bit.
Please.
Please be exactly the same.
Yeah, just scramble.
Scramble.
30 something.
Well, you're allowed to bring in old quizzes to the exam, so I can't make them exactly the same. I can make them similar though. But good, I'm proud of you, working hard. So email me if you have any questions.
Oh, thank you.
Okay, you bet. Time value of money.
Not a formula.
Or
This is the table. I'm gonna use this. Is that okay, right?
Yeah. All right.
Not with my cell phone, but I'm gonna print it out.
Okay.
And probably your textbook has it as
That's just fine. I just feel like.
Yeah, because I don't want to calculate a stupid, square or.
But what if it's like 8.5%? Then you have to.
I have to calculate it.
Yeah.
But I can figure out between 8 and 9, and is it recording?